Okay, now we move on to our next topic, capital budgeting. So what is capital budgeting? Capital budgeting is actually relates to the decision-making process of selecting and evaluating a long-term investment. So this one focus on a long-term. Alright, number two, making the right decision is important because this project require a huge amount of cash flow committed for many years. So basically, it's going to affect the huge amount and it's going to be related to more than 1 year. Alright, so this is the capital budgeting process. Number one, generating long-term investment proposals consists of a firm's long-term objectives. So it's going to relate with a long-term objective. Right, number two, estimating and evaluating the relevant after-tax incremental cash flows for these project proposals. So what we have to do is, number two, we are going to analyze the after-tax cash flow, the incremental of the cash flows. And number three, selecting the project that will maximize the shareholders' wealth. So it means that here we have to analyze whether this one will increase the shareholders' wealth or not. And number four, if re-evaluating this project from time to time to control purposes and carrying out post-audit for completed project. So basically, I'm going to repeat again. So number one, we are going to focus on the long-term objective of the firms. Number two, we are going to focus on the incremental of cash flows, which is after tax for a company. And number three, the project should be maximize the shareholders' wealth. And number four, we have to re-evaluating from time to time. Right, so there are two types of project. Number one, independent project. So what are the independent projects? So these projects whose cash flows are independent or unrelated to one another. So decision to accept one project will not affect the decision to accept another. Alright, for example, you have two projects, project A and project B. If you accept project A, it will not affect the decisions of project B. Alright, so for example, if you already accept A, you also may accept project B and also may reject project B because those projects are independent. Alright, what about mutually exclusive projects? So these decisions is made to choose only one project from many being considered. For example, let's say we just have two projects. If you accept project A, then you have to reject project B. Okay, for example, if you have 4 projects, if already you accept one, the 3 that you have to reject. Alright, next one will be types of capital budgeting decisions. Alright, number one is for expansion, number two is for the replacement. So expansion means that through the acquisition of fixed asset or non-current asset, so it depends on the company itself, how they would like to expand their business, either to purchase a non-current asset, or they would like to introduce new product, or they would like to penetrate a new market, or they would like to open a new branch. So it depends on the situation. Right, number two, replacement of the existing assets. So existing asset here should be in a normally huge amount. Alright, guidelines for the capital budgeting. Number one, use cash flows and not accounting. What we are going to focus is only for the cash flows, but not for the accounting profit. So what is the cash flows? Reflect amount of cash received and cash paid out. So it means that we are going to focus more on the money received, money in, and money out. So what is accounting profit? Includes that accrued expenses and depreciation, which do not involve any flow of cash, but are being subtracted from the revenue. So this one we are not to consider all the expenses, for example, which is not related with cash. Alright, number two, focus on the incremental after-tax cash flows. So here, this represents the changes in the firm total cash flows that occurs as a direct result of the accepting the project. So what we are going to analyze here, we are going to see the changes in the total cash flows of the company. Alright, number 3, we have to consider the synergistic effect. So the synergistic effect occurs when products are complementary in nature. In nature. So an increase in cash flow to any part of the company that may result from the decision at hand. Right, number 4, consider the loss of revenue from the existing product. So we have to consider also occur when the products are competitive in nature. Alright, number 5, what we have to do next is ignore sunk cost. Why we have to ignore sunk cost? Because a sunk cost is a cash flow that has incurred and cannot be recovered regardless of any decision that you made. So it means that here this kind of decision, this kind of cost will not affect your decision. It doesn't matter what kind of decision, whether to accept or not to accept. It's not going to affect. Alright, next, number 6, include opportunity cost. So what is opportunity cost? It's actually cash flows that are foregone in relation to one project by accepting another project. Okay, so this one you have to take into consideration. Alright, number 7, incorporate working capital requirements such as new inventory to stock, a sales outlet, additional investment in account receivable. So for example here, if we would like to have a new inventory or we have to, put some money in order to invest in account receivable. So this one will resulting from additional credit sales or increase in investment in cash to operate additional cash registers. So this one also we have to take into consideration because once we, for example, if we do our expansion, change of our asset, it will affect our inventory and account receivable. Next, number 8, so we have to separate investment decision from financing decision. So we cannot combine together the investment and the financing. Alright, if accepting a project involves raising funds by issuing bond, interest payment and other financing cash flows that might result from raising funds to finance a project should not be considered incremental cash flow. So this one, if we would like to combine, we have another topic in our degree, so we can combine the financing and also the investment decision. But for diploma level, we have to separate between the two, between the investment decision and financing decision. So these are the relevant cash flows that we have to analyze in order to accept or to reject a project. So number 1, we have to consider the initial outlay, and number 2, differential or incremental cash flow over the project's life, and the third one is the terminal cash flow. So now we are going to analyze, so what is initial outlay? So also called as the initial investment. So initial that you have to, invest in a certain things. For example, you purchase a new asset or, we would like to open a new branch. So at the initial stage, so this is the amount that we have to contribute. Alright, number 2, immediate cash outflows necessary to purchase the asset and put in operating order. And number 3, include purchase price plus any expenses associated with shipping or installation. So it's not only the cost of the asset, but we also have to include the expenses that related with the shipping or the installation of the assets. Alright, number 4, include non-expense cash outlay such as increase in working capital requirement. As I mentioned earlier, if this kind of investment a new investment or purchase of new asset, it will affect your new capital requirement, then we also have to take into consideration the cost of the increase in the working capital. Alright, number 5 must also include any cash outflows such as training expenses or special engineering expenses that would not have been incurred otherwise. For example, if we would like to implement this kind of software or non-current asset, so we need staff to train. So this kind of expenses also we have considered. Alright, next one, number 6. If it is a replacement decision, for example, we would like to replace the old machine with a new one, so the cash inflow associated with the selling price of the old asset, in addition to any tax effect resulting from its sales, must be included. Right, number 1, when the selling price is more than the net book value, so we are going to have a profit on disposal. So we also have to consider the tax paid or tax loss result in the cash outflow. Okay, so this one, for example, profit on disposal. So what will be the effect on the company? So the company should pay for the tax. Profit on disposal. So this one will reflect, it will result in cash outflow. Alright, number 2, when the selling price is equivalent to net book value, no profit, no loss, right? And number 3, when the selling price is less than net book value, so the company will have loss on disposal. So the company did not have to pay tax, so it is a tax saving, so it will result in cash inflow. Alright, so this is related with the old machine if we would like to sell the old machine. So we have to consider whether it's a profit on disposal or loss on disposal. Next one will be the determination of the initial outlay. Alright, so we have to consider the cost of a new asset. And then we have to plus with the capitalized expenditure such as the transportation costs, custom duties, installation costs, and etc. So if we have this kind of cost, we have to add it together, and then we have to plus or minus, it depends, increase or decrease in level of net working capital. If it will increase, then we will have to plus. If it will decrease, so we have to minus. And then minus with proceed from the sale of an asset. For example, here tax charge or tax saving due to the sales of an old asset. So after we total up this one, it will give us the initial outlay. Next, we have to analyze the differential cash flow. So here we name it differential cash flow or incremental cash flow. Alright, so so annual cash flows that will be received from year to year until the project matures. Alright, next one, increase in cash flows may be result of maybe increase in sales, labor costs or salaries, decrease in cost of defects, and decrease in operating expenses. So we have to analyze whether this one will give increase in cash or increase in cash inflows or not, or decrease in cash flows that may be result from increase in electricity, increase in operating expenses, increase in advertising expenses, increase in maintaining expenses or maintenance expenses. So from here we have to analyze whether this one will increase in cash inflows or this one will decrease in cash flows. Alright, so we have to consider, okay, because we would like to analyze the total of the incremental cash flows. Alright, determination of a differential cash flow. Differential cash flow, it means that from the previous until we implement the new one, so what will be effect from the previous year compared with the current year if we implement a new project. Alright, so net increase or decrease in operating revenue, okay, and then we minus or we add with any increase or decrease in operating expenses, and then we have to exclude our depreciation, okay. Alright, and then we plus or we minus with net increase in depreciation, and then what will give us is equal to net change in income before taxes. And then we have to minus or plus back with our increase or decrease in taxes. So this one will give us net change in income after tax. So we have to plus or minus again, or increase in decrease in depreciation. So lastly, we are going to get the figure of incremental net cash flows for the period. I think this one we are going to give you a specific example or do together the specific question to see the increase or decrease in cash flows. Alright, so the other one what we have to analyze is the terminal cash flow. So terminal cash flow, it means that at the end, so cash flow that occur only at the project's termination. It include salvage value of the new machine, or it means that the value of the machine at the end of the useful life, and then less tax if any, and the net working capital recovered. So terminal cash flow, so final salvage value of the net asset. It means that plus or minus tax charges, tax savings due to the sale of the new asset, and plus minus with increase or decrease level of working capital. So this one will be equal to terminal cash flow.